Hey everyone, thanks for joining us for another deep dive. You sent us this fascinating article from the Motley Fool all about dividend stocks. But not just any dividend payers, we're talking blue chip companies.
Right.
Trading at multi-year lows. These are big names, you know?
Right.
The kind that are usually associated with stability, but
Yeah.
their stock prices haven't been this low in years.
That's right.
So are we looking at a red flag or a hidden gem?
Well, that is the question, isn't it? And that's what we'll be looking at today. What's pushing these prices down? What strengths do these companies still have?
Yeah.
And ultimately, can we help you figure out if they might be a good fit for your own portfolio?
Awesome. So let's jump right in, and the first company on our list is PepsiCo.
Okay.
Their last quarter of 2024 showed basically flat sales, which isn't exactly thrilling, but their profits actually jumped by a significant 16%.
Yeah.
What's going on there?
Well, it's an interesting situation for sure. And it might point to some pretty savvy maneuvering on PepsiCo's part. So while flat sales could indicate consumers are pushing back against price increases,
Right.
that profit surge suggests they're really good at managing costs.
Okay.
So the key here is figuring out how they're achieving this. Are they streamlining their supply chain? Are they investing more in automation?
Interesting.
Understanding those tactics is going to be really crucial to figuring out if this is sustainable for them over the long term.
That makes sense, because squeezing costs can only take you so far, right?
Exactly.
This article also mentions that PepsiCo is a dividend king, which sounds kind of cool.
It is pretty cool.
Yeah.
It means they've increased their dividend payouts to investors for at least 50 consecutive years.
Wow.
That's a really powerful signal in a market like this,
Right.
It speaks to their commitment to shareholders
Right.
over the long haul.
So for someone listening who's looking for stable dividends, PepsiCo might be worth a look,
It might.
especially with that stock price down and a 3.6% dividend yield. But as always, due diligence is key.
Absolutely. Weighing potential growth against the current market mood is super important. Don't just buy because of that Dividend King title.
Right. Okay, next up we have UPS, and this one has a little plot twist.
Okay.
They're actually trying to reduce their reliance on Amazon. And if I remember correctly, Amazon is their biggest customer.
Right.
That seems kind of counterintuitive, doesn't it?
It might seem that way at first glance. But UPS CEO Carol Tomei believes this is actually the best path to profitability.
Okay.
The company is shifting its focus away from just chasing revenue growth and instead prioritizing profit margins.
So they're saying goodbye to that quantity over quality approach?
You could say that. And that's definitely made some investors nervous. Some are wondering if this is too drastic.
Yeah.
Stock has dropped back down to 2020 levels.
But for someone listening who's in it for the long haul,
Yeah.
this emphasis on profitability could actually be a good sign, right?
Potentially, especially with that tempting 4.9% dividend yield.
Yeah, that's a lot higher than average.
It is. It's much higher than the S&P 500 average. The question is, can UPS successfully navigate this and attract new high-value clients?
To fill that Amazon-sized hole.
Exactly.
All right, moving on to Merck. This is a healthcare giant that's facing a couple of hurdles, according to this article. They've paused shipments of their HPV vaccine Gardasil to China.
Right.
And there are concerns about potential competition for their blockbuster cancer drug, Keytruda.
Yeah, so the China situation is complex. It's a combination of weak demand over there,
Right.
and you can't ignore the potential trade war anxieties.
Right.
As for Keytruda, the concern there is that keeper biosimilar versions are going to hit the market in the next few years. These are essentially like generic versions of biologic drugs.
Okay.
Similar efficacy, but lower cost.
So not great news for Merck on either of those fronts.
No, not really.
Yeah?
But there is a potential bright spot.
Okay, what's that?
Merck is developing a new, easier-to-administer version of Keytruda.
Oh, interesting.
If they can offer comparable effectiveness with greater convenience, it could be a real game changer.
Yeah, it makes sense.
And it's also worth noting that Merck has a really strong pipeline of new drugs in development. So that could offset potential losses from Keytruda.
So there's hope for them yet.
There is definitely potential.
Especially since Merck is trading at a very low price-to-earnings ratio right now.
Yeah,
Maybe the market is undervaluing them.
it's possible.
Mm.
But as always, a deeper analysis is needed. We need to look at their long-term growth prospects and how well they're managing these current challenges.
To see if they can keep delivering value to shareholders.
Exactly.
And for our listener who might be interested in Merck, the key takeaway here is...
Merck has a solid track record, but it's facing some strong headwinds.
Yeah,
So it's a balancing act. You're weighing the potential rewards of that low price-to-earnings ratio
right.
against the risks associated with those China concerns and the looming biosimilar competition.
So we've got these three blue chip companies, all with a history of solid dividends, but they're all facing their own unique set of challenges.
That's true.
And it's probably making our listener think, okay, so where do I go from here?
That's the million-dollar question, right?
Yeah.
Maybe looking at some broader market factors that might be influencing these so-called blue chip bargains will help.
Sounds good to me. Let's unpack that in the next part of our deep dive. So we took a look at the individual stories of PepsiCo and UPS and Merck. But let's zoom out a bit. What are some of the bigger market trends that might be affecting these so-called blue chip bargains?
Right. Well, I think you have to start with the big one, inflation.
Mm-hmm.
Rising costs impact everyone from everyday consumers to massive corporations.
Yeah, makes sense.
When companies like PepsiCo have to raise prices to keep up, they risk losing those customers.
Which leads to those flat sales we talked about.
Exactly. And it's not just inflation either, right? We've also got geopolitical tensions and supply chain issues, and everyone's talking about a potential recession. It is. All of that just adds to the volatility in the market.
So how does our listener, the individual investor, make sense of all this? How do they figure out what's important?
That's where long-term perspective is so important.
Okay.
These ups and downs, they're just part of investing. You got to stay focused on where you want to be, not get distracted by every little bump in the road.
It's easier said than done, though, right? When the market takes a dip, it's hard not to panic.
I know. But sometimes those dips create opportunities.
Yeah, that's true.
And that's why it's so important to really understand these companies. Are the problems they're facing short-term blips or signs of bigger issues?
That's the question everyone wants answered.
Right. And that's where a deep dive like this is so helpful. We're not just looking at stock prices. We're looking at the whole picture.
Their strategies, the risks, the potential rewards.
Exactly. We're giving our listeners the information they need to make those tough decisions.
So for our listeners who are trying to navigate this storm, what are some key things they should remember?
Well, first things first. These companies are down for a reason. There are legitimate concerns affecting their prices, but they also have a history of bouncing back.
Right. They're not fly-by-night companies.
Exactly. They have established brands and a track record of paying dividends.
So it's all about balancing the potential reward with the risk.
Exactly. And that's where understanding your own risk tolerance is so important. Some people might look at these multi-year lows and see a great buying opportunity. Other people might want to wait and see what happens.
It's really a personal decision.
It is. And we should remind everyone that this is just a starting point.
Right.
It's a conversation starter.
Yeah.
But ultimately, it's up to each individual investor to do their own research and make the decision that's right for them.
And if they're not sure what to do, talking to a financial advisor is always a good idea.
Definitely. They can offer more personalized guidance.
Okay, so we've talked about the financials and the market forces at play.
But there's one more layer we need to consider, right?
Right. The social impact of these companies.
Because it's not just about profits anymore. No, it's not. Investors want to know that the companies they're supporting are operating ethically and responsibly.
So let's look at their ESG performance.
Good idea. ESG stands for environmental, social, and governance. It's a way to measure a company's impact on the world.
Okay, cool. So starting with PepsiCo.
They've actually made some pretty impressive commitments to sustainability. They're working on reducing their carbon emissions and water usage and packaging waste.
Wow, that's great.
They're even exploring more sustainable farming practices.
That's really interesting. And they've also been recognized for their work in promoting diversity and inclusion.
That's right. How about UPS?
What are they doing?
Well, they're investing a lot in electric vehicles and alternative fuels.
To reduce their impact on the environment.
Exactly. And they've also set some big goals for improving safety and reducing accidents.
I didn't know that.
And they're pretty involved in disaster relief and community outreach.
So they're doing good work on multiple fronts.
They are. How about Merck?
Well, they're a healthcare company, so they have a big responsibility to make sure people can afford their products.
Especially in developing countries.
Right. And they're working on global health challenges like HIV/AIDS and other infectious diseases.
So as you can see, it's not just about looking at a company's financial performance.
Yeah.
It's also about considering their ESG track record.
And finding companies that are both profitable and making a positive impact on the world.
Exactly. Now, the big question, so are these blue chip bargains worth adding to our listeners' portfolio?
That's what everyone wants to know.
The truth is there's no easy answer. It depends on a lot of factors, like their individual goals and risk tolerance and values.
We've looked at the challenges these companies are facing and their strengths and their ESG performance and the broader market context.
Now, it's up to each listener to decide if these companies are a good fit for their own investment strategy.
You know, it really feels like investing is about so much more than just like picking stocks and hoping for the best.
Well, it definitely is.
Hmm.
It's really about creating that financial future that's aligned with your goals and values.
Yeah.
What do you want your life to look like? What are your goals? Are you trying to buy a house, start a business, travel the world, or just have the financial freedom to pursue your passions? It's all connected.
And I think what's so interesting is that these huge companies with their long histories and familiar names, I mean, they're facing the same uncertain future as everyone else.
Yeah, that's right. And that's why we have to look at their strategies. How are they adapting to these challenges? Are they holding on to old ways of doing things? Or are they innovating? Are they changing with the times? That's what's going to tell us if they can survive in the long run.
That's a really good point. It's not just about what they've done in the past, it's about their ability to navigate the future. And I think that brings us back to our listener. They've spent their time with us, they sent us this article. So what's the big takeaway here? What should they be thinking about as they consider these blue chip bargains?
Well, I think the biggest thing to remember is that investing is a journey. It's not a sprint to the finish line.
Right.
It's about making smart decisions, not just jumping in because something seems exciting. These multi-year lows might look tempting,
Yeah, for sure.
but you have to understand why the price is so low. Is it just a temporary dip, or is there something fundamentally wrong with the company?
So it's not enough to just find a bargain.
Exactly. You have to look under the hood. And remember, diversification is your friend. Don't put all your eggs in one basket. Spread your investments across different sectors and asset classes. It can help protect you if things go south.
That's always good advice. And we've explored those risks pretty thoroughly today, right? We talked about inflation and geopolitical tensions and potential recessions and even the rise of biosimilars. It's a lot to think about.
It is. But the more you know, the better prepared you'll be to make decisions that align with your goals and your risk tolerance.
So our listener is probably thinking, should I buy these stocks? Should I wait and see? Should I just stay away?
And the answer is, it depends.
Yeah.
We've given them a lot of information. They need to go back and review it. Maybe look into the company's financial statements. Think about their ESG performance. And if they're still not sure, talking to a financial advisor is always a good idea.
Absolutely. Because at the end of the day, the decision is theirs.
That's right. And I hope what we've done today is give them the tools they need to make that decision with confidence.
And maybe spark their curiosity to keep learning.
Exactly. The world of investing is constantly changing. It's what keeps it interesting.
Well said. So to our listener, thanks for joining us on this journey into the world of blue chip bargains. We hope you learned something new, maybe had a few aha moments along the way.
And keep those questions coming. Investing is a lifelong journey, and we're here to help.
That's right. Until next time, happy investing.